Is this a bubble waiting to burst, or is it a new financial revolution? Let's dive into this topic further. But first, let's understand the current stock market surge. The S&P 500's push past 6,000 signifies a remarkable transformation in investor sentiment. Historically, equity markets have grown alongside improvements in productivity, innovation, and profitability. However, 2024's rally has been fueled by several unique factors, including Trump's re-election and his seemingly pro-business and crypto-friendly stance, tech innovations, and finally investor FOMO, with both retail and institutional investors reluctant to miss out on what could be a once-in-a-generation opportunity. Honestly, so many of my friends are entering the market right now, which could be a concerning factor, especially if you've heard this story about the shoeshine boy. But should we have any concern, or is the optimism justified? To answer this, let's explore both the bear and the bull cases in greater depth. But first, let's jump into the bear case and why critics warn of a bubble. Up first, we have the Trump trade effect. So, since Trump was re-elected, markets have surged, with Tesla up nearly 30% this year alone. Investors are betting heavily on reduced regulation and tax cuts, policies that they believe will bolster corporate profits and drive economic growth. However, critics argue that these moves may be premature. Regulatory and economic changes take time, and there's no guarantee these policies will yield the growth that investors are expecting. To this point, markets historically overreact to political development, and there is a risk that this so-called Trump trade could turn into a massive flop. At number 2, we have the argument that stocks are overvalued and that there is a concentration risk in the market. The rise of the Magnificent Seven, which is Nvidia, Amazon, Meta, Microsoft, Google, Apple, and Tesla, has been extraordinary, but their valuations have raised eyebrows. These tech giants account for a disproportionate share of the market's gain, leading to concerns about market concentration. For example, Nvidia has soared over 2,700% in the last 5 years, driven by dominance in AI chips. And also, Apple recently crossed the 4 trillion market cap mark, even though iPhone sales are dropping. Such valuations are difficult to sustain without a significant growth in the underlying earnings. The reliance on these 7 companies for the majority of market growth means that the broader market is vulnerable if any of these firms stumble. So, concern number 3 is that equity risk premiums are shrinking. The equity risk premium, which is essentially the extra return that investors expect from stocks compared to safer assets like bonds and gold, has been shrinking. As bond yields rise, thanks to the Fed tightening their policies, the relative attractiveness of stock diminishes. If markets are pricing in perfection, any negative surprises could cause a sharp correction in stock prices. And number 4 is that AI spending is either a boom or a bust. And as you know, AI has been a key trend for 2024, and Nvidia's massive rise reflects investor confidence in this sector. Yet, not everyone is convinced. Companies are pouring billions into AI infrastructure, but profits from these investments may take many years to materialize. Historical analogies such as the dot-com bubble suggest that speculative enthusiasm can outpace the actual economic impact of technologies. Also, the energy required to power Gen AI could ultimately hinder growth, especially balancing this with sustainability targets. And it's without doubt that AI can potentially transform the world. However, the near-term financial risks cannot be ignored. Now we've understood the bear case, let's jump into the bull case and reasons for optimism. On the other side of the debate, bulls are arguing that today's market rally is fundamentally different from past bubbles. They believe that we're on the verge of a new era of growth, driven by tech innovation, fiscal stimulus, and resilient corporate profits. The first argument in the bull case is that Trump's pro-business policies are causing significant optimism. Trump's policies, including corporate tax cuts and deregulation, are expected to unlock significant economic potential. Lower taxes leave businesses with more money to invest, whilst deregulation reduces the operational costs that they have. For example, retail firms such as Amazon and Walmart may benefit from consumers having more disposable income that they're able to invest in their goods. On the other hand, financial institutions could see higher profits due to more relaxed regulatory constraints, lowering their overall cost to serve. This combination of corporate and consumer incentives has the potential to drive a period of economic growth. Point number 2 is that we're seeing a broad-based market growth, contrary to what I just said in the bear case. Unlike the dot-com era, today's market rally isn't limited to just one sector. In addition to tech, industries like energy, healthcare, and consumer goods are seeing gains. Even cryptocurrencies, long dismissed as a fringe asset, are experiencing renewed interest. Bitcoin's rise to 98k is a testament to its staying power as a store of value, whilst Ethereum's smart contract functionality continues to attract developers and investors. Point number 3 is that we have record profits and productivity gains right now. One of the most compelling arguments for the bull case is that strong profitability of large blue chip firms. Despite concerns about valuations, profit margins remain near historical highs. Innovations in automation and supply chain management are driving efficiencies, allowing companies to deliver more with less. And at number 4, we have the view that the AI revolution will drive long-term growth. Proponents of the bull case liken today's technological breakthroughs to that of the Industrial Revolution. AI, robotics, and renewable energy have the potential to transform industries ranging from manufacturing through to healthcare. If these trends continue, the market's optimism may prove to be well-founded. Finally, let's touch on the crypto comeback. No discussion of 2024 financial markets would be complete without examining crypto resurgence. After a brutal bear market of 2022 and 23, cryptocurrencies have roared back to life. In my view, there are 3 things that are driving crypto growth right now. The first thing is industrial adoption of crypto. Major players such as BlackRock and Fidelity have recently launched Bitcoin ETFs, thus legitimizing crypto as an asset class. This has attracted a new wave of institutional investors, pushing prices higher, especially as you can now gain exposure to cryptocurrency via tax wrapper accounts such as the Stocks and Shares ISA in the UK. I've personally been doing this a lot recently. The second key factor helping crypto right now is regulatory clarity. The US government has introduced clearer guidelines on crypto taxation and usage, therefore reducing the uncertainty and encouraging adoption. And finally, at number 3, we have technological upgrade. Ethereum's shift to a proof-of-stake model has significantly reduced its energy consumption, addressing one of the major criticisms of cryptocurrency. Now, whilst this growth is extremely exciting, cryptocurrency remains a highly speculative market. Meme coins such as Dogecoin may deliver crazy returns, but they're also prone to sharp declines. Long-term investors should focus on more established assets like Bitcoin and Ethereum, which have proven their resilience time and time again. Now, I'm not going to say don't buy them, but know they're speculative, and if you do invest in them, only allocate a small portion of your fund to them. Finally, let's jump into the last section, lessons for investors. Whether you're a seasoned investor or a newcomer, the current market environment offers both opportunities and challenges. Here are some key takeaways to help you. First, diversify your portfolio and don't put all of your eggs in one basket. Having a mix of equity, bonds, and alternative assets like crypto can help you to mitigate your risk whilst also helping you manage the upside. Number 2 is to focus on fundamentals and to avoid chasing speculative gains. Look for companies with strong earnings, manageable debt, and also competitive advantages. Number 3 is to be prepared for volatility. Markets rarely move in a straight line. Expect corrections and stay disciplined in your investment approach. Number 4 is to stay informed. The financial landscape is consistently evolving. Keep up with economic trends, policy changes, and technological developments to make informed decisions. And finally, for long-term investors, the key is to stay the course. Whether the market is experiencing a bubble right now or entering a new era of growth, history shows us that disciplined investing pays off over time. Personally, I'll continue to focus on index fund, ETFs, and a diversified strategy that balances growth with stability, investing by dollar cost averaging every week. As always, do your research and consult with your financial advisor if you need. If you'd like to learn more on how to manage your money like the elite, allowing you to invest while also enjoying your life, watch this video here. See you in the next video. Happy investing.